si registrerà la conferenza.
So the recording has started. Thank you all for being here. This is the joint seminar titled Securities Markets, Trends, Risks and Policies, co-organized by CONSOB, first of all, ESMA and Bocconi University through the Buffy-Carefin Center. I'm Massimo Guidolin. I am a professor at Bocconi University and I represent Buffy-Carefin. And today I have the pleasure to introduce Tobias Dieler from University of Bristol, and is giving a talk titled Repo Resilience. And let me just spend a few words, but basically I will explain the entire paper. No, just kidding. It's a very important paper at the intersection between theory and policy, in the sense that we are living turbulent times, in the sense that financial markets have been shocked recently, starting with the great financial crisis, but also later with big waves of what the paper calls dash for cash. So institutions all running at the same time to hoard cash and causing liquidity crisis in a very important portion of the financial system, which is the repo market. And since then, the policymakers as well as the researchers have become aware that we need to think more carefully about the optimal structure of the repo market. And there are two competing models. One is a European centralized, say, public market, and Tobias will tell us the detail of how it works. And there is a traditional US model, which is a over-the-counter, say, model in which transactions are on a bilateral basis often. And it's not clear which one is the winner in the light of a reform, and Tobias will show us model and empirical evidence basically disclosing maybe once and for all what is the optimal choice. And I think there will be a final surprise. I was joking with him, but I will not ruin the surprise, and I will let Tobias present the paper to us. Tobias, you have the floor.
Thank you very much, Massimo. Thank you very much for this very kind introduction, and for this brilliant summary of our paper. I guess I couldn't have motivated it any better. So thank you for including my paper in the in the original program of your conference, and now for reorganizing it as a seminar series. This is joint work with Laureano Mancini from Lugano and Norman Schürhoff from Lausanne. And what we are trying indeed in this paper to do is to kind of do a horse race between these different market structures in US and Europe, which are OTC market mostly in the US and CCP-based markets mostly in Europe. And so in order to do this, I quickly introduce a bit the repo market functioning. So here in this figure, you can see on the bottom, I don't know if you can see the hand moving, is the indicator when I...
Yes, yeah. Yes, we can.
Okay, great. So here on the bottom, you have essentially the borrower, and here on the top, you have the lender. And so starting out from the bilateral market, in repos are, well, the lender provides cash to the borrower, and the borrower provides in return collateral, which are most of the time liquid treasury bonds, government bonds in general. Then you have another market structure which works through a tri-party agent, where the tri-party agent is an intermediary, and in the US most of the time this is JP Morgan. And so instead of going around and searching for a lender, the borrower can just approach JP Morgan and they will find a lender. So they kind of provide immediacy, like a bit like a market maker. And then you have this the CCP structure, which resembles a little bit a tri-party market, but has many distinguishing features from a tri-party market, and to which I will come in just a moment. So what are we doing here is we are asking the question, which market is more resilient and which market allocates resources more efficiently in funding crisis. And now let me go a bit deeper into what the different market features are. Starting by the OTC market. And when I talk about the OTC market, I mean both bilateral and tri-party markets. And I mean both bilateral and tri-party markets because both of these markets are non-anonymous markets, meaning that as a lender, you know who your counterparty is. And that is going to be one of the decisive differences between OTC and CCP markets. Indeed, in the OTC markets, therefore, lenders and borrowers can condition repos and that is rate, loan amount, and collateral on borrower quality and counterparty risk, if you wish. On the other hand, we have the CCP, which is cleared through what is called a central order book. And there, and there, borrowers and lenders do not observe each other's identity, but trade through an open order book. So how does it work? It is that borrowers post loan amount, interest rate, and collateral, and then the lender observes the post and can lift the order to accept it, or or then if they don't lift it, obviously they don't accept it. But what is important here is that next to this order, there's no the lender cannot observe who they are dealing with. So this is what makes this central order book effectively anonymous. Then another distinguishing feature is that once lenders and borrowers have agreed upon a repo and through the central order book, the CCP steps in and becomes the legal counterparty to both borrower and lender. This is what is called novation. Furthermore, the CCP has a default fund in place to which borrowers and lenders, depending on the activity and the exposure on the CCP market, have to contribute so that in case of a borrower's default, all participants on a pro rata basis repay the defaulting borrower's debt. Okay. So these are the main differences for our analysis between OTC and CCP markets. Let me tell you a little bit about the empirics or the how these markets are distributed across the globe. So in the US, the estimates range, the estimates of the size of the market range between 5.5 trillion US dollars and 10 trillion US dollars. Europe is somewhat similar in size, so these are fairly old numbers. We know that since then these markets have further increased. So these are sizable markets. In the US, roughly 2/3 of the interbank market goes through bilateral and tri-party repo, so that is our OTC market. Whereas in Europe, roughly 70% of repo contracts are done via a central counterparty. Now, these are what motivated our study are the following stylized facts. So we often observe a contraction of OTC markets, most notably during the great financial crisis, which has been documented in these papers, which I list there. Then we had the repo blow up in October 2019. And then again, during the COVID-19 outbreak, OTC markets were considerably disrupted and sometimes even came to a halt. Whereas the CCP markets seem to have weathered all these crisis periods fairly well. So this was the starting point of our why we started diving into this and try to understand better what is going on. The main trade-off we are highlighting in our paper is the following. So the OTC market allows lenders to condition their loans on the credit quality of borrowers, and therefore the market maximizes revenue, maximizes the total economy's revenue, but low quality borrowers have to bear the cost of the funding shocks. and therefore narrow runs on low quality borrowers may occur. On the other hand, the CCP market allows to share the burden of the funding shock between low and high quality borrowers, and therefore the market provides insurance for low quality borrowers to continue rolling over their repos. But, and this is a big but, there's a potential that there's a systemic run on the entire market. As a consequence, we are showing that welfare rankings between OTC and CCP markets switch repeatedly for different level of funding shocks. Okay, we have two main sets of findings, and I'm not sure whether I get through all of them, but I want to briefly give you the main gist. So here's the first set of main findings. OTC markets are prone to narrow runs on low quality borrowers for relatively small funding shocks. So this seems to be in line with the empirical evidence, which I was showing you, that during crisis times, OTC markets are easily susceptible to runs. COB markets, so what I mean by COB, markets with central order books provide insurance to low quality borrowers, but may be subject to a systemic run. Remember that COB, the central order book, is just one feature of the CCP market. There are more features in place in the CCP market, which then add the following results in our paper. There's, as I pointed out before, there's novation in place and there's a default fund in place. What novation effectively does is it excludes low quality borrowers from the COB market and therefore averts a systemic run and replicates a narrow run like in the OTC market. Furthermore, the default fund provides additional insurance for low quality borrowers and therefore allows markets to absorb larger size funding shocks. This is the second set of results, and in which we show that liquid collateral plays two roles. Firstly, it increases market resilience against runs. So this is, I guess, fairly expected. And it increases efficiency, allocative efficiency in the CCP market. This is essentially because collateral makes borrowers internalize their negative externalities to the market. Furthermore, this is a fairly recent development, so most of you who had the paper beforehand might not have seen this. We pinned down a optimal repo market design, which essentially consists of an OTC market, so a non-anonymous market, with a default fund which consists of two sections. One section in which there's a collateral transfer from high quality to low quality borrowers, and another section in which there's a profit transfer from, again, high quality to low quality borrowers. And this solution almost perfectly replicates the first best solution. The model also helps to reconcile the convenience yield puzzle between great financial crisis and COVID-19 outbreak. So a few of you might be familiar with this convenience yield puzzle, which essentially says that during great financial crisis, the convenience yield of collateral went up, whereas during COVID-19 it dropped. And so we provide some explanation for why this might have happened. Okay, how do we contribute to the literature? Well, clearly, first of all, by contributing to the literature about repo markets. Haider and co-author have an anonymous a paper with anonymous lending and anonymous unsecured lending, I should say. So there, clearly, we contribute that we have an anonymous secured lending plus all the CCP typical CCP features. Martin et al. They focus on the bilateral and tri-party markets, and there clearly is no CCP in place. So our biggest contribution is this profound study of all the different CCP features. We are also at the intersection between the optimal opacity literature and the maturity mismatch literature. So the optimal opacity literature, and there we're closest probably to Dang and co-authors, has also this optimal opacity, obviously, similar to our CCP market, but they don't have liquidity shortage like we will have in our paper. So that no runs can occur in these papers. In contrast, well, in the run literature and the typical classical run literature, there's no asymmetric information about borers, which we add to this literature. So if I have to summarize what is our contribution, it is we are defining when it is welfare improving to trade and clear repo over a CCP market, and we derive policy suggestions to improve repo market design. The model in a nutshell. And so borrowers have heterogeneous long-term technologies for which they need financing. The long-term technology is financed with short-term loans, and that's what creates this maturity mismatch problem. Borrowers learn their technology's quality over time, and the economy, at the same time, the economy is subject to a funding shock. So what you can really think of here is Lehman waking up one morning and realizing, oh, we have a lot of these problematic asset-backed securities on our balance sheet, and at the same time, there's a dry up in the funding market. When rolling over loans, anonymity in the CCP market provides insurance for low-quality borrowers but prevents efficient resource allocation, whereas OTC markets allow lenders to condition loan terms on borrowers' type, and therefore, when funding is scarce, low-quality borrowers receive only the residual funding, and therefore are prone to runs. Okay, I don't know if you have. I don't know, I'm going fairly quick, but if you have a question, just interrupt me or as you prefer. Okay, so I dive straight into the model. We have two generations of 2M risk-neutral lenders with an endowment of 1 unit of cash each. So these lenders, they live for one period, and at the end of their life, they consume their endowment and their profit. Second generation lenders, and this is how we implement the funding shock, receive a liquidity shock with probability alpha and none with the opposite probability. We have two risk-neutral borrowers with a long-term technology in which they can invest I0 at T0, and it yields a gross return at maturity of R omega times I0. And omega can be either low or high, and RH, so the high return of the long-term technology, occurs with probability beta, and RL occurs with probability 1 minus beta. For the talk, I will assume that the long-term technology has a positive NPV NPV project, meaning that 1 unit of investment yields more than 1 unit of return at maturity. And obviously, the ranking between RH and RL is as such. If the long-term technology is liquidated early, so if you liquidate an amount of the long-term technology, you obtain a return of lambda, which is less than what you initially invested. And this is how we implement the maturity mismatch problem, obviously. Clearly, you cannot liquidate more than what you invested. So Z has always to be less than what you initially invested. Then borrowers have an additional endowment of a risk-free asset, which they can use as collateral. It is risk-free because the return is deterministic with kappa t at time t. And borrower holds K0 of this collateral at T0, and if they liquidate some of it at T1, then the return is slightly smaller than they would have obtained at T0, and they will return at T2. So this is, you can think of as transaction cost or liquidation cost. Now the following is an important assumption. We assume that the liquidating collateral is less costly than liquidating the long-term technology. And this you can see from this pecking order here. So these are measures of opportunity cost of liquidating each of the respective assets at the intermediate stage. In the denominator, you have the return from liquidating the asset early, that is lambda for the long-term technology and kappa 1 for the collateral. And in the numerator, you have the return of liquidating the asset at maturity, which gives you RL for the long-term technology and kappa 2 for the collateral. And so, because you have this higher opportunity cost of liquidation from the long-term technology, you always prefer to liquidate collateral before long-term technology. Furthermore, we assume scarce collateral, which means that liquidating both collateral, all of the collateral, and all of the long-term technology at T1, at the rollover stage, is not sufficient to fully repay the first round loan. This timeline summarizes the model. So at T0, borrowers and first round lenders negotiate a loan, or repo, consisting of a gross interest rate of C1 and a loan amount of L0. Then borrowers can use this loan to invest into the long-term technology, I0, and obviously I0 cannot exceed L0. Then at T1, second round lenders are subject to a funding shock. Borrowers observe their types, so this is how they learn about their long-term technology. They privately observe their types. And borrowers and second round lenders negotiate a new loan, C2 and L1. C2 again, gross loan rate, and L1 the loan amount. And finally at T2, payoffs realize. Now, what I want to highlight here is that going from T0 to T1, there's a potential decrease in the amount of funding available in the economy. So in this, at T0, the funding available is this 2M coming from all potential lenders. Whereas if a funding shock realizes, here there's less than 2M available for borrowers to roll over their loans. And that is what is causing this rollover problem to become interesting. Okay, now in the next step, I will do the horse race between the OTC market and the COB market, the central order book market, and I will focus on the rollover stage, as that's where the action happens and where the rollover. So let me start out with the non-anonymous OTC market. In this market, borrowers and lenders can condition the loan contract on the borrower's type. That's why I indicate this loan contract here with this superscript omega to indicate the borrower's type. Now, the interesting bit is the repayment condition. So let me start by talking about this one here. So what is the objective here for the borrower? It is to repay first round lenders, that is this amount here, and they can do so with a mix of new loan, collateral, or long-term technology. If they have to liquidate collateral, then that obviously decrease. So they can they first liquidate collateral and then long-term technology. The cheapest is always to just obtain a loan and repay with a new loan first round lenders. Now, that then shows in the borrower's profit. So here, conditional on being an omega type, this is the return the borrower gets from the long-term technology at maturity, minus the cost from the loan, plus the return the borrower obtains from liquidating the collateral at maturity. Observe that both long-term technology and collateral are decreased by the amount the borrower has to liquidate in order to make and to repay first round lenders. And then second round lenders, they at least want to break even, obviously. And so how the way we pin down down the equilibrium is by Bertrand competition in interest rates, which means H-type and L-type compete for funding up to the point where the L-type breaks even, meaning that this expression that the borrower's profit condition is binding. Then the H-type borrower can potentially outbid the L-type by a little bit and therefore attract all the funding. Indeed, the H-type borrower obtains exactly the funding he requires to repay the first round loan. Therefore, the H-type will never have to liquidate neither collateral nor long-term technology. They can fully repay the first round lenders with a new loan. Instead, the L-type only obtains what is left, so to speak, and therefore has to liquidate, well, depending on the size of the funding shock, a little bit of collateral, and if that's not enough, they also have to start liquidating long-term technology. Now, I don't worry too much about the expression here. What I want to show you is that the interest rate is decreasing in the size of the funding shock. And more importantly, that our run is truly driven by the lender's decision not to provide funding anymore. When do lenders continue to, up to which point do lenders provide funding? Well, exactly up to the point where they make where they break even, right? Where this condition here is binding. Since their return is decreasing in the funding shock, there exists a size of the funding shock for which this condition here, for which lenders break even. And this condition is characterized as our FOTC, the run threshold. The run threshold determines up to which point the L-type borrower obtains funding. Beyond this threshold, so if the funding shock is larger than FOTC, the L-type no longer obtains funding and has to liquidate both long-term technology and collateral. So this lemma states the OTC equilibrium. As I pointed out, the H-type can always roll over their initial loan because there's enough funding in the economy to do so. So they don't have to liquidate neither long-term technology nor collateral. What about the L-type? So for small funding shocks, the L-type starts liquidating the collateral to repay first-generation lenders. And as the funding shock increases, and in fact, when they run out of collateral, they also have to start liquidating part of their long-term technology. And well, when F is so big that it exceeds the repayment condition of the lender, lenders stop providing funding to the L-type, and therefore the L-type has to liquidate both collateral and long-term technology. Instead, in the anonymous central order book market, lenders and borrowers cannot condition on borrower type. In fact, we are looking at a pooling equilibrium in which both interest rate and loan amount are the same for both borrowers, for both borrower types. So we talk about a one-fits-all loan. Again, we have this repayment condition, and as you can see from here, a one-fits-all loan implies that both borrowers get half of the endowment in the economy which is available for funding, and so they just split the pie, so to speak. And you can see that the funding available for the L-type is larger in the COB market than in the OTC market. However, the funding available to the H-type is smaller than in the OTC market, which then implies that not only the L-type has to start liquidating part of their collateral and their long-term technology to repay first round lenders, but also the H-type, and in the same way as the L-type. We show that this equilibrium survives all incentive compatibility, excuse me, and that this is robust to the intuitive criterion. Similar to the OTC market, this is an individually optimal run, but here what is the difference is that when lenders break even, they not only stop providing funding to the L type, but also to the H type. So there's a market failure. And that point is again characterized by a run threshold, which in this case is FCCP. We go on to show, okay, sorry. So let me summarize this. The COB equilibrium requires both low type and high type quality borrowers to liquidate part of their collateral for small funding shocks. As soon as they run out of collateral, both of them have to start liquidating part of their long-term technology. And when funding shocks are very large, the market fails, meaning both H-type and L-type borrower have to liquidate both collateral and long-term technology. We go on to show that the CCP market provides insurance to the OTC, to the low-quality borrower in the following sense: that the run threshold in the CCP market is larger than in the OTC market if the long-term technology is illiquid. But that's the main point of the analysis. Now, let me highlight the differences between these two markets in this graph here. So on the vertical axis, I draw net welfare, which is the ex post net wealth, ex post utility of both borrowers and lenders, first round lenders and second round lenders. And on the horizontal axis, I depict the funding shock, the size of the funding shock. For orientation, I also highlight the first best solution in the red line, on the red line. As I pointed out, for small funding shocks in both markets, so in the OTC market, which is the blue line, and in the COB market without novation, which is the black line, for small funding shocks, the L-type has to liquidate their collateral up to the point where they run out of collateral. Now, in the COB market, the L-type runs out of collateral later than in the OTC market because they obtain a larger loan than in the OTC market. In the OTC market, and that's why the blue curve starts dropping earlier than the black curve. The L-type has to start liquidating long-term technology, whereas in the COB market they are still liquidating collateral. That is why there's a steeper drop in welfare in the OTC market than in the COB market. But then once also in the COB market, borrowers run out of collateral, which is at that point where F is equal to kappa 1. Then not only the L-type has to start liquidating the long-term technology, but also the H-type, and that's why this decrease here is steeper than in the OTC market, where only the L-type liquidates the long-term technology. Then the more the L-type has to liquidate long-term technology in the OTC market at this point FOTC here. That is when there's not enough money left in the long-term technology to guarantee the repayment of second-round lenders. And that's when second-round lenders stop providing funding to the L-type, which means they have to liquidate the long-term technology and the collateral, which causes this drop here. So beyond here, there's only the H-type, which continues the long-term technology, and the L-type has to completely liquidate, or in other words, defaults. This is where the insurance in the COB market comes into play, where both H-type and L-type are still present in the COB market and can continue to roll over their long-term technology up to this point here, at which FCCP, at which lenders stop providing funding to both L-type and H-type and borrowers. And then indeed, the drop here is a lot deeper because not only the L-type has to liquidate both collateral and long-term technology, but also the H-type, and that causes this very steep drop in welfare. Okay, now if we go and consider the other remaining CCP features, meaning novation and default fund, then we obtain the following result. So this is almost the same figure as I showed you before. Here the blue line is still the OTC market, but now the green line is the line we saw previously in the COB market, which then drops here dramatically after the systemic run. Now, the only thing which changes when you introduce novation, and let me recall what innovation means. It means that the CCP becomes the legal counterparty to both borrower and lender. And obviously, there will not become a counterparty to a borrower which is going to default. So what this novation effectively does is it expels low-quality borrowers from the CCP market and only novates repo contracts between H types and lenders. And therefore, we have we no longer have the systemic run in which both borrowers default, but we have this result, just like in the OTC market, that the L-type defaults. So there's still this drop here, but the L-type defaults because it's excluded from the market by the CCP, but the H-type can continue rolling over. And therefore, we obtain the same result as in the OTC market. If we go one step further and conclude, so to speak, the CCP market, so now we have truly the full CCP market. So meaning we have the central order, we have clearing over through the central order book, we have novation in place, and now we add the default fund. The default fund is effectively a transfer from the H type to the L type, which is agreed upon joining the CCP market. So in particular, before borrowers realize of which type they are. I mean, that is the typical nature of an insurance. Then if there's this default fund in place, you can further extend the run threshold to the right. And so this is this purple line. And you can see that from the black line, which I showed you in the previous slide, we just essentially extend the resilience of the COB market by introducing a default fund. Okay, I don't know how I'm doing in time.
Tobias, I am, but we have to consult with Daniel about time. Well, in principle, it's 1 full hour, but I don't know whether the question will allow you.
Thank you, Massimo. Tobias, there's no problem. If you need 10 minutes, I think it's fine. It's okay for you?
Yeah, sure.
Okay.
Yeah.
Perfect.
Okay. Then we look into the remaining features of repo markets, and first and foremost, collateral. We show that collateral has an asymmetric effect on the different types of markets. So one might expect that because the run threshold in the OTC market is smaller than in the CCP market, that the effect of collateral on these run thresholds is stronger in the OTC market, the marginal effect. That is, however, not the case if the long-term technology is illiquid. Because if the long-term technology is illiquid, the CCP market forces the H-type to liquidate, so to speak, too much of their very profitable long-term technology, and therefore protecting this, protecting the H-type by having a liquid, high-value collateral in place protects actually more the CCP market, and increases. So it increases the resilience of any market collateral, but it increases more so the resilience of the CCP market. Then we look at the convenience yield, and let me tell you a little bit about what the convenience yield is. It is the using collateral or using a risk-free asset as collateral instead of liquidating it on the spot market. So what is the benefit of using it as collateral versus what is the gain of liquidating it on the spot market? That is what is defined as our convenience yield, and that's how it's defined in the literature as well. Now, what we show is that, or we provide support for the empirical evidence showing that the convenience yield increased during the Great Financial Crisis and decreased in the COVID-19 outbreak. What is the idea here is, or the explanation our model suggests that average borrower quality was low due to large positions in asset-backed securities on banks' balance sheets during the Great Financial Crisis, and therefore that leads to an increase in convenience yield in our model. Whereas during COVID-19, banks were better capitalized and had higher credit worthiness than during the Great Financial Crisis, which leads to a decrease in convenience yield in our model. And finally, so there is this concern by market participants about the CCP market, which is can be kicked down the road. What does it mean? It means that can poor quality borrowers hide in these CCP markets and continue rolling over their low quality projects. And so this is a valid concern. And to this end, we introduce then negative NPV projects in our model and see what happens. And what happens is that we can show that the combination of novation, so meaning that the CCP has to step in between borrower and lender and become the legal counterparty, and collateral prevent actually the risk of hoarding in anonymous CCP markets. Risk hoarding in anonymous CCP markets. And finally, we have some policy suggestions which come directly out of our analysis. And so we pin down the optimal market solution. And one of the suggestions is that, and so this is the current debate in the US, to which extent the OTC market in the US should be shifted to a central clearing platform. And what we are showing here is that, so this is this I don't know, light blue line here, OTC with default fund. What we are showing is that yes, we should continue doing OTC repo, but then then move the repos agreed upon OTC onto a central clearing platform, which features a default fund similar to the CCP market. So essentially, you have the best from both worlds. You have the efficient resource allocation from OTC markets, but then you also have the insurance benefit from the default fund. And indeed, you can see here in this example that the OTC market with default fund is not only the most efficient in terms of resource allocation, so it still doesn't reach the first best, but it is clearly larger, especially for large funding shocks than the CCP market, and in particular, it is more resilient than any other market in place. Okay, I think I conclude here. So what do we do? We study funding crisis in a canonical model of asymmetric information about borrowers, and we highlight a novel trade-off between resource allocation and market resiliency. We show that anonymous CCP markets, and what we mean by that is central order books plus novation plus default fund, provide financial stability, while non-anonymous OTC markets allocate resources more efficiently. Thank you very much for your attention.
Well, thank you, Tobias. I think I have to also render the honor of host. Daniela, how do we proceed from this point? I mean, we look for questions and comments to Tobias.
Yes, if there are questions, I think it's a good time. Anything?
I have a question. I will let other people speak before I do so.
If there are no questions, we can introduce Dr. Andrea Gentilini. What do you think? It's okay to proceed? I think it's better, and then we can ask about questions at the end of the discussion.
Sure.
Welcome. It's a great pleasure for us, for me, to introduce Andrea Gentilini. It's very important the discussion about the paper of Tobias Dieler. This Professor Dr. Andrea Gentilini come from Luxembourg. It is the head of market division infrastructure. Very complicated, but has a long experience in the supervisory, and is also in the regulation, in particular in market infrastructure. Excuse me. Then I think it's the best thing is to introduce Dr. Gentilini. Please, let's go with your discussion. It's very welcome.
Yes, thank you. Thank you very much for everyone, and thanks for giving me the opportunity to speak to this conference and to discuss about this paper. I have some, let's say, some slides that I will go through. I don't know how and can show these, but
you can share pressing the button.
Okay, I'll do in a while. Yes, so let me back.
Your microphone.
Okay.
Yes, screen open. It should. Let me. Oh, that's quite strange. Okay. Yes. Well, I try. Well, there's something that doesn't work. Well, oh, I think that then I have an issue, but anyway, otherwise I can.
Yes. A cheap possibility is that you email your slides to Tobias.
Indeed, that's exactly what I was thinking about,
Okay,
because at the end it's easier, and I don't want to let's say to waste too much time for technical let's say
no, but also Tobias can actually share the slides. He has the knowledge on how to do it.
I let me easily to share, and so that's going to be, let's say, so as email, and I may share to so I'm double moving here to so I can share to Tobias, isn't it?
Yes. But now I have no longer the right to share. I think you have to make me the presenter again. If I am.
So.
Daniela, can you make me the presenter again?
Daniela, can you make Tobias the presenter again?
Yeah, you
yes. Are. You can present, Tobias.
Okay, yeah. As soon as I have the slide.
One issue because I got a problem. So, well.
Thank you for this very complicated coordination of the organization.
No, because unfortunately, I'm in the meantime, I was, and this is the reason why I joined later, but I was in an important ESMA call, so I'm jumping from one topic to another, but sorry for this. Here I am.
No,
so Tobias, I just sent to you the documents.
Okay.
No problem.
And so well, I would say the main point I want to mention here for this discussion is that I really appreciate the paper because this is something that is unusual, at least for today's until today, to have paper that focus on SFTs. and on SFT, well, let's say repos and other type of securities financing transactions with this point of view, and the paper is, let's say, well detailed and comprehensive. If I may, just I would say to start with a few anecdotes that brings me back to Bocconi, where I graduated. I spent my first year of PhD, and then I moved to Luxembourg, where I continue to work. But in the last few years at Bocconi, I was at the IGER, Innocenzo Gasparini Institute for Economic Research, as teaching assistant and research assistant. And at the time, I had the opportunity to work closely with several Bocconi's professors, and in particular with Francesco Giavazzi and Rudy Dorbusch, with which I participated to a research on that end up with a paper at the European Economic Association conference in Bolzano. And during those working, basically, and you can go quickly to the second slide. At the end, this is what told me Rudy Dorbusch. He told me that I learned more about Spanish economy one day on the train from Barcelona to Madrid than in all books and newspaper articles he read and in the seminar he attended. So looking at the reality. Second element is another anecdote. When the IGER website has been reshaped, I was requested to provide the feedback, and I said, well, I prefer to have analysis and data because it sounds better. But Carlo Ambrosio Favaro told me data and analysis, data and analysis. Remember, Andrea, data always come before the analysis. And Francesco Giavazzi, nodding, said, Professor Favaro is right. It's easier for an analysis to be wrong than the data on which it is based. And based on those two principles, I read the paper, and I will bring my point of view on this paper. So my point of view had not to, let's say, to raise any question about the paper itself, but it's just to highlight some additional elements and room for improvement from a regulatory point of view, from a market perspective point of view, which is something that could, let's say, could enrich the paper itself. So if we can move to the next slide. Yes, so this paper is a very ambitious goal, and I really like it. So the model provides condition for when non-anonymous OTC repo markets are more resilient than anonymous CCP repo markets, and when proposed reform to existing repo markets improve financial stability and welfare. And at the end, the model provides several novel insights to the ongoing policy debate in the US about whether to move repo contracts after they have been agreed OTC onto CCP. The authors show that such reform can be welfare improving, in particular in repo market are equipped with a default fund. So please, next animation, just to, this is something that I really like in the paper, because I would say this is the emirization of the OTC repo market. So in somehow it seems that, or the idea behind seems very, let's say, familiar to us, to me, that I'm very involved on market infrastructure and EMIR, so European Market Infrastructure Regulation, the regulation that cover derivatives and introduce risk mitigation techniques, central clearing, all those stuff for derivatives. But at the end, the idea, or I mean, the red line that I identified along the paper was something familiar to me, and I said, well, this is good, because SFTR, which is the European regulation that currently tackle SFTs, repos, sec lending, etc., only refers to an additional, well, a new obligation in terms of reporting. While there is the risk behind, the risk is, let's say, managed by market participants through collateral, third-party agents, and all the technicalities. But there is no specific regulation that introduced a new obligation or that's standardized obligation for market participants. So this is something that I really appreciated. Then quickly, sorry, for the next slide. Well, the paper is structured in a very nice way. So the mob, and here you can, Tobias, you can go, because this is just at the different blocks. What I really found good, let's say, the nice journey from the model to the description of the OTC market, to the feature of the CCP market, then the analysis of the OTC versus the CCP, with the idea of the welfare in the OTC is larger than welfare in CCPs, the trade-off in the CCP market, where the COB provides an insurance benefit, however the COB generates social cost from resource and misallocation. And please, sorry about that, but so then the next elements are, so you can continue to click. So the TCP features, the collateral, and at the end, the idea that the OTC repo markets need to be centrally cleared. And centrally clearing platform members have to contribute to a default fund. So this is, I really appreciated really the structure of the analysis and all the modelization that has been made, because really is a journey and you bring the reader with you. And this is very clear and really fascinating. It's really at the end, despite that there's a lot of math, but it's like reading a book. So at the end, you understand from the beginning to end, and you are really, you drive the reader along with your analysis and consideration. This is something that I really appreciated. So then I will start from now. I will give my, let's say, my input, my critical input. So next slide is the first point. I highlighted the potential developments in terms of repo market in US and Europe. So you state at the beginning of the repo that US repo markets are for most part decentralized with bilateral non-anonymous trading and discriminatory pricing. In contrast, European markets in large parts rely on CCPs with anonymous repo borrowing and lending, non-discriminatory pricing, central clearing, innovation, and default funds. So please, you can click again, and then you have my additional points. So first of all, in Europe, the direct trading covers almost 64%, while and of which almost 10% is a three-party, while voice brokers is near 9%, and near 30% is automated through a repo trading system, so the so-called ATS. So if you click again, you have additional figures. So domestic is 25%, cross-border to Eurozone is 17%, and cross-border to other non-Eurozone is 35%, while only 22.3% is anonymous. And we can imagine that, well, those figures came from the European Repo Market Survey from ICMA, issued in November this year, based on the outcome of the questionnaire that has been, let's say, provided in June. So our figures as of June 2020. And according to ICMA, the anonymous is the CCP, and you see that more or less there is a kind of consistency between the 22% anonymous versus the 27 in automated repo trading system. So in somehow, if you look at the figures tell us slightly a different story. And if we go back to the ICMA figures, of course, you see that more or less those data are consistent over time. Basically, they don't change too much. Nevertheless, ICMA report states something that is very useful, at least from our point of view as regulators, because they mention that looking at the first preliminary SFTR figures that are available, the data are not really consistent. And this is something interesting. Well, 2 points when you want to compare data available from SFTR, which is the reporting obligation introduced by this new regulation, and ICMA, is that ICMA is a questionnaire, so the providers give the information, and so is a partial by nature. But the other side, also SFTR, since it has not been fully implemented, so currently only, well, at least in June, only banks and CSDs basically started to report, while funds started in September, and non-financial counterparties, so the huge corporate players, will start early next year. So it's still, I would say, an incomplete picture where we can understand that the CCPs and CSDs being the ones that report with banks, while the outcome at the end can be, I would say, overestimated. And in the next release of the data, we should see some normalization. Once again, also this reporting is let's say, despite is a mandatory, but depends on the entities that report. So can also, but the point here is just to look at the data in order to probably add some nuances on this. So if we look on the next click, we have figures from US, where the base is the SIFMA research and repo market, but then you have also the Federal Reserve of New York and other institutions that look at the data. And if you look at the data here, well, they are not really comparable, but you have bilateral repo markets, average daily aggregate repo, and reverse repo outstanding is 4.5 trillion, while the repo market offered by the CCP, which is the FECC, is 35 trillion. So even in US, the figures looks like a bit different. So what I suggest after this first point is look at the data and try to present and to dig a bit more in the reality in order, I would say, to draft a context which is more or less more consistent. Otherwise, this could be, let's say, a weak point in your paper, which, as I said before, I really appreciated. Next slide. This is a snapshot of your paper where you focus on OTC repo market and CCP repo market, and you provide a lot of arguments that are very interesting and useful. But I want to focus on one point. So if you can click several times, everything will appear. Sorry. You said that OTC market allocate funding more efficiently than COB markets. However, well, you have to pay attention that anonymity has a value participants are willing to pay. So why people want to go to the CCP is, well, they are able to pay let's say, a less efficient outcome because, well, they can benefit of some return because they, well, consider corporates, consider, for instance, big holdings, where companies are sitting on shares of, let's say, big shares. I mean, good and important portion of equities for unlisted companies. So they can simply gain additional value simply providing those securities as, let's say, putting them into the SFT, so repos, but also securities lending, etc. So they can gain additional, well, they have an additional source of revenue, I would say, for free, because anyway, otherwise they will sit on those, let's say, bonds and stocks doing nothing. But for them, at the end, the anonymity is relevant, because so at the end, no one knows that they will play with the assets they have. So in somehow for them, it's you may also consider that CCP is not a complete alternative, but it's something that in somehow enlarge the cake. And so with CCP, you can reach participants, I will say, well, if it's not the right, but counterparties that are willing to play under the condition to be anonymous, because they don't want to disclose. And this is one of the major points that we will have with SFTs and SFTR, because with the reporting, they are obliged to be disclosed. And so
there? Not sure.
Tobias, you're not alone, but Andrea is frozen.
Okay.
In case you're wondering, is it me?
The surprise of technology, it's not in this case. But I don't know, it's a problem maybe of the connection of Andrea.
Tobias, you have the slides, you can discuss yourself.
I can present it myself, you say? I'm not sure I can.
You would have to read them first, but but let's be patient, like 1 minute, right, Daniela? It may come back.
Just turn on my light.
Okay.
Otherwise, one solution is that I ask at least one question to Tobias, and then when Andrea comes back, we can have the rest of the discussion. It's a bit garbled.
Okay.
Now, I saw Andrea's picture disappearing, so maybe it's a good sign or a very bad sign. Something is happening. Okay, so too much blank. So let me put also my face on. Tobias, one question, which is so in the end, your conclusion is that optimality is reached by forming a sort of hybrid between the two models. Yeah. But let me ask you, is it possible for the two models to coexist? Or do you think that it's not in your model, okay? But if you had a model with both, do you think that one of them will actually, in the end, monopolize the market and be left the only structure for repo trading?
So here I'm going to cheat a little bit by saying, I mean, from Andrea's presentation, we just learned, and I mean, this is also, I mean, we knew this before, that indeed these markets coexist in one jurisdiction, right? So even though small, I mean, you have a CCP market in the US, even though small, you have an OTC market in Europe. Or so
is that an optimal outcome, or is just something that happens because of frictions?
Yes, and we have looked into this, and we have tried. So what we see is that it is more costly for borrowers to go to the CCP market. So in expectation, they. But if you introduce some kind of search friction in the OTC market, or some kind of transaction costs in the OTC market, depending on the size.
Yes,
the
sorry.
market. Okay.
Sorry. I had a problem with the power supply. So
yeah.
Sorry.
Yeah, just 1 second. In the meantime, we asked Tobias a question, so we'll complete answer the question and then you can resume. Sorry for the mess. Sorry, Tobias, go ahead.
Yes. So so we had a look at this at when markets coexist, and it is more costly for borrowers to be on the CCP market. That also comes out of our analysis. So in order for them to actually coexist, there needs to be some kind of search friction in the OTC market. I mean, whatever cost we attribute to this, is it search cost? Is it that you have to verify more? Because I mean, the CCP does a lot of work for you already, right? They vet all the potential borrowers. They check the collateral. They do all the transaction. So I mean, the transaction of cash and collateral, they do. I mean, it's all at the mouse click for the participants. Whereas OTC,
as it stands, no, in the sense that the OTC would win unless you force things to be CCP based, basically.
Yeah.
Okay.
And,
no, as you wish. Okay. Otherwise, I will vanish and Andrea can actually resume.
Yeah, sure.
Thank you.
Thank you for the question. Andrea?
Yes. So sorry. So going back, the idea was just to pay attention that the anonymity is relevant, and so you may also soften a bit or to be a bit more complete on this aspect. So the third point that I want to raise to your attention is in the next slides, and is the CCP default waterfall. So you said that the default fund in CCP market increased the market resilience against the runs, as it allows to transfer profit from solvent to insolvent borrowers. Well, I give you some snapshot on the default waterfalls, which is the default fund plus other things. And well, the last, the three picture, but the last one, so the one on the right hand side, it came from the a paper from the Bank of International Settlement, and as you can see at the end, the default waterfall is structured in, let's say, in two blocks. The first block is the let's say the defaulter pays principle. So CCP use the default, the funds of the clearing members that default, and only if those are not sufficient, then you have the survivor pays principle. And then I agree with you that in somehow there is the payment, well, the solvent, let's say, pay for the let's say the insolvent pay for the profits from solvent to insolvent. But in somehow your statement is once again probably a bit too let's say too radical, and I would suggest to let's say to take into consideration also this aspect, which is quite spread. Let's say in Europe you have EMIR that detailed how this default waterfall has to be structured. In US you have Dodd-Frank Act. So in the meantime, starting from the G20 in Pittsburgh onward, let's say all the world has introduced this type of things. So at the end, it is important to take them into consideration, because it's true, but only, I will say, for the last mile. So it's preferable, I will say, to precise this in order to avoid that somebody could let's say could consider that your arguments are not correct, which is not definitely the case, and I want just to reiterate again. So those are pictures that I found well familiar with, but to make it easy, I found from internet, and you will find well, all CCPs have some description, because of course they use also this in terms of marketing for being more attractive compared to other CCPs for their activities. So the fourth point that I raised, identified, is the CCP membership criteria. So once again, I found a statement which is, I would say, a bit too radical, while if you click again, well, this is just two examples, but well, first is from LCH, which are two CCPs, one in France and one in UK, and the other is from Eurex. But when you have the clear elements in terms of the membership criteria, which is on top of that also a requirement from the regulation, at least in Europe, under EMIR. So where you say that the first line of defense for CCPs is the criteria to accept members. So in somehow at the end, the CCP with the membership criteria facilitate that at the end there is a good quality in terms of well, say, in the market of derivatives, in terms of counterparties that enters into derivatives, but also in the repo and in the securities lending. The clearing member play a role to let's say, like to signal the quality of the participants, because of course they are responsible for the quality of their client, and in somehow they risk to be put out from the CCP because of some clients of not let's say adequate good quality. So in somehow there is a good incentive mechanism that has been introduced where at the end the shift of the responsibility move from the CCP to the clearing member. So this is something that I suggest you to take into consideration in an appropriate way. I don't give you any, let's say, indication how to integrate. This is really, I would say, I let you the freedom. I would just to raise some points, I would say, that are, let's say, originated more from the practice, everyday practice dealing with those topics and those entities, because they are CCPs and CSDs are definitely market infrastructure. So that's why I propose you to pay attention on those points. Fifth point is the next slide, and is, I will say, this is something where I really want to quite interesting, because is really this part which is quite I would say interesting. So if you click again, the reader may be puzzled at the end, because you start from the OTC market and CCP market, sorry, then you make the comparison between the two, then you highlight the CCP features, central clearing default fund, and then you suggest to have a central cleared OTC market. But the question that the reader and myself, I asked myself is, but are we closing the circle? So are we going back to what a starting point? Because What is a central cleared OTC market, and what is the difference between, and probably this is one of the questions that you already asked when I was offline, and apologies if I repeat, but what is the difference between your outcome, so a central cleared OTC market versus a CCP? Or are you exactly figure out what I mentioned at the beginning, the immerization, so meaning that you want to add some elements, some risk mitigation techniques in somehow that increase the soundness of the bilateral things, bilateral market. But in this case, I will, this may be just the wording, but you know, words counts, and central cleared OTC marketing somehow is CCP market, because for derivative, at least people talk about CCP or central clear derivative. So in somehow there is a kind of potential confusion, and I will highlight your attention to avoid this confusion. So in somehow what you may call is, let's say, enhanced OTC, or can be risk mitigation techniques, or consider other, let's say, variation on the concept of mitigation techniques or whatever, but not create the confusion. And this is I think, but if you click, but this is things my let's say last above point. The next slide is a kind of let's say sixth element, which is at the end of the resume of everything. So data and literature. The paper is very dense and very rich in modeling, and I agree with your models because, as I said, what I want to bring you is just additional elements that aim at addressing the what I found as weaknesses in your paper. So that's why at the end I summarize in data and literature. So some more data in order to create, even with statistical and facts and figures, some description of the market, looking at ESMA, ICMA versus SFTR data. But then there is a lot of literature that have been produced by the European Systemic Risk Board on shadow banking. That was the, let's say, the name used in the past for repos and SFTs. So there is a lot of literature that I didn't see in your reference list, which is mainly based on articles, papers, etc., which is the classical, let's say, academic literature. While I really recommend you at least to read something from ICMA, from SIFMA, from the American in US OFR, but also from the ESRB, and if not the Bank of International Settlement, because they provide, but sometimes even interesting academic research paper, but often, let's say, descriptive statistic of the market that facilitate you to, let's say, to be more micro-founded into the reality of the markets today. Because this is, if I can summarize, this is what the missing part in your paper was, the, let's say, the link with the reality. And I really recommend you, because I really found your paper very interesting, to close this gap in order to have a very interesting paper. And thanks a lot, because I really, you know, you bring me back to 20 years ago. So I really appreciate your paper and this work. Thank you very much.
Thank you, Andrea. Thanks a lot for the discussion. For I don't know, should I reply or?
Yes,
yes.
So yeah, thanks a lot, Andrea. And this is amazing. I think we couldn't have wished for a better discussion. Being such an expert on CCPs and pushing us to tie it even closer to the real markets. And I think this is well, this point is very well taken. I quickly want to go through a few of your comments. I think so at the beginning you showed data about that the US market is not fully OTC and the European market is not fully CCP. I completely agree. Obviously, we are not saying that this is the case, right? That the European market is only CCP and the US market is only OTC. We only have the empirical evidence for OTC markets from the US and we have no empirical evidence from the European markets, European OTC markets. So that's why we presented a bit in this US-European comparison. But what we really want to do is a horse race between these two market structures, and it's not really a race between Europe and US. It's more between these two market structures. And unfortunately, we only know of data from the US for OTC markets and for Europe for CCP markets. So this is something which is, I think, also missing in the literature, and I guess would be a good contribution to the literature if there's more empirical evidence. So I think I want to clarify, our horse race is not US versus Europe, it's OTC versus CCP. And we are well aware that there exists in both markets. I couldn't agree more. Anonymity has a value for. So you're saying anonymity has a value for participants, which is beyond. Which allows them essentially to hide a little bit their portfolio choice and their trading, I guess. So I'm going to say something what theorists usually say at this point. This is action which is not really in our model, right? So that they have a competitive advantage by maybe not revealing what they are doing with their collateral. Yes, for sure. I for sure agree on this, but we don't have this in our model, so it's going to be difficult to make a good point. Out of this at this stage, I think we have to think. We would need to think harder about this. So I'm very glad you brought up the waterfall procedure and in particular the default fund. So I think this is indeed something we are very sloppy in the paper and that needs clarification in the following sense. So in the paper, in the model, it is true that before the default fund is used, all of the defaulting borrowers proceeds are used up. So that means the proceeds from the long-term technology, the risky asset, and the collateral as well. So it is a bit like in the real world that the distribution of losses among the other participants is only a matter of last resort, and really only when all the resources from the defaulting borrower are used up. And that's indeed what we have in the paper, but I think you're absolutely right. We should spell this out a lot more in detail. So, of course, you're right. The CCP selects its members, and to that extent, there is some kind of risk management going on. I completely appreciate that point. I would still argue that there is some heterogeneity still among borrowers. For sure, they are not the weakest ones, the weakest banks in Europe. Let's say if we talk about the Eurex, I think the Eurex has currently 150 participants. They are all the typical banks which usually jump to your mind, and they are well vetted. They are we know what they have on their balance sheet. But still, if you are the lender, you don't know now if you're lending to Deutsche Bank or if you're lending to UniCredit. And I would argue that it's still that there is still a difference whether you lend to one or the other. There's a difference in counterparty risk, and that's what we want to highlight in our paper, that there's some missing information about counterparty risks due to this anonymous market. And I take your point very well about what is. I had to smile a little bit. What is centrally cleared OTC in comparison to CCP? Sure. Yes. Okay. I want to clarify this. So for us, centrally cleared OTC it's a non-anonymous market. So I think this is the main difference to the CCP. That a centrally cleared OTC for us is a market where you meet one-to-one, you know your counterparty, but then you have to move to a central clearing platform which also has a default fund like a CCP. But again, The main difference between CCP and OTC is that you know in this centrally cleared OTC who you are lending to. So you're a lot more clear about the OTC, about the counterparty risk. And I think I want to stop here. Thanks a lot for your, I really appreciate your comments. Thank you very much.
You're welcome. That's my pleasure. But if I may just correct one point, I know that we are rushing out of time, but just to say exactly. So my point was just to raise awareness in order to facilitate you to be more precise without changing the spirit and the elements of your paper, but just to be not to slip on some let's say details of the real world. And you can simply, you know, sometimes just a footnote it's enough, but the point was just that footnote must be in the paper in order to be complete and exhaustive. Thank you.
Thank you. Thank you. That's a very good point. Thank you.
Thank you, Tobias, and also Andrea. Very interesting discussion. I think it's very, it's the point that Andrea showed us was very interesting. And so I don't know, Massimo, you have some question now? Other
no, I am all done with questions. It's okay. I'm okay.
Okay. And from the audience, there are questions now? I think not, because we have very analyzed all the every topic, and very interesting are some on one end we have a very clear and interesting presentation by Tobias of the model, and then we have on the other hand we have discussion very important, and the discussion is actual and stress about the data about to give to introducing your model the reality, or a little bit to think about what happens. And I think, for example, anonymous it's a very good point to in this case. Now I think it's the time is finished. I would like to thank you very much to Massimo Guidolin, to very great support in this webinar. Very welcome all your presentation, and also I hope to meet again also Tobias, but also Andrea Gentilini. Andrea Gentilini, thank you very much, because your discussion was very great. I think it's also the PowerPoint was very clear and explained very well your point. Thank you so much. See you soon.
Thank you very much for organizing this. Thank you for having me. Thank you.
Thank you.
Bye.
Thank you. Thank you.